The meme stock craze during the COVID-19 pandemic gave a lot of people a really distorted view of what normal investing looks like. Wowed by tales of people becoming overnight millionaires, many amateur traders made bets on risky options and penny stocks, only to see their pandemic relief checks go up in smoke. Now here's a little secret. Overactive traders and small cap speculators almost always lose money in the long run. So what do you do if you're just a regular Joe investor who has a pile of cash sitting around losing value to inflation? Let's talk about a few lower risk ETFs that actually pay you cash every single month. Now, back in the 1980s, bonds were hot. Nowadays, not so much. People are often distracted by the latest shiny thing, like, for example, the recent market pump that was fueled by AI hype or the recent Bitcoin buying frenzy. But lately, I've been buying up bonds, and I'm not alone. According to a recent story in the Wall Street Journal, institutional investors and pension funds are selling billions in stocks and loading up on bonds too. Now, are you interested in buying monthly dividend bonds but don't know where to start? Let me tell you how I go about it, and then I'll talk about some options that may appeal to people based on how much risk they're willing to take on. Now, I buy bonds using exchange-traded funds or ETFs. Now, ETFs are highly liquid assets that you can buy and sell on the stock market, just like you would Apple or Amazon shares. And with fractional trading offered by newer platforms like Robinhood, you can start investing in them for as little as $1. I've compiled a few examples of bond ETFs that I own that carry different levels of risk that I'll tell you about now. Now, I just want to be clear, though, that these are for illustrative purposes only. I'm not suggesting you buy or sell any of these ones in particular because I'm not a financial advisor. I'm just a guy on the internet who likes talking about investing. So please do make sure you speak to an actual financial advisor before making these kinds of decisions and never bet with money that you can't afford to lose. Okay, so let's go. Now, first we'll talk about an extremely low-risk bond ETF. So if you're just looking for somewhere to park your cash and collect dividends while you decide what to do with it, you could do worse than the Spider Bloomberg 1 to 3 month T-bill ETF with the ticker BIL. Because BIL holds ultra short-term U.S. government debt, it's about as safe as you can get, and the price really doesn't vary that much. So the description is that the index measures the performance of public obligations of the U.S. Treasury that have a remaining maturity of greater than or equal to 1 month and less than 3 months. So we're talking ultra short-term here. Now, because interest rates are so high right now, the dividend yield at the time of this writing is 5.09%, and BIL pays out dividends monthly. Now, let's talk about more of a medium risk bond ETF. So if you still want the security of U.S. government debt, but with the possibility of some capital appreciation as well, the iShares 10 to 20-year Treasury bond ETF might be of interest, and that goes by the ticker TLH. Now, like BIL, it also holds Treasury bonds, but these ones mature over a longer time period. So the yield is a bit lower at 4.02%, but if interest rates go down, the value of bonds do tend to go up. So, of course, with inflation still looking sticky, there's a possibility that these bonds could actually go down too if the Fed decides that it actually needs to hike rates a bit more, which would go counter to the narrative presently. But as I mentioned, inflation has been stickier than they were anticipating. Now, let's talk about a higher risk bond ETF. So if you're looking for higher yields and higher potential upside, and you're willing to take on a little more risk, you might be interested in something like the iShares JP Morgan USD Emerging Market Bond ETF, which goes by the ticker EMB. Now, this fund also invests in sovereign debt, but from emerging markets that may not have the same level of stability or as high of a credit rating as the U.S. government does. Now, EMB is currently yielding 4.77%, and like the others that I've mentioned, it also pays out dividends every single month. Now, a lot of people have a stocks or nothing approach to investing, but people who don't explore other avenues, I think, are doing themselves a bit of a disservice in the long run. Like, it isn't always a great time to buy stocks, just like it isn't always the best time to buy bonds or real estate or whatever else you're interested in buying. So the more options that you give yourself, the more you can diversify your portfolio and take advantage of great opportunities when market conditions are right. So folks, let me know in the comments, what are you buying right now? Are you still focused on stocks? Are you looking at other investments too, like bonds, real estate, all that sort of thing? And folks, if you enjoyed this piece, then please do take the time to like, subscribe, all that good stuff, and we'll talk to you again soon.